This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed-sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
Thank goodness the questions just keep coming in. Thank you, thank you, thank you. Not thank goodness, thank you for sending in those questions at talkingrealmoney.com on the contact form and then speaking them into your mic on your computer or your phone or whatever you got a mic with. Everything's got a mic these days. So it's really easy to do. You don't even need a phone, but you can do it on the phone. Hey, this is the Friday Q&A edition of Talking Real Money. I'm Don McDonald. Thanks so much for listening. I really appreciate all of you being there, but particularly Tom's grandkids. They're my favorite audience out there. Sorry, the rest of you. You know, hey, I think they're also my youngest listeners, and they listen religiously. They're going to be rich, unlike some of you. So take a lesson from the grandkids. Anyway, welcome to another edition. We've got a lot of questions. Well, okay, questions and other stuff. There's a lot of stuff, a lot of content in this one. So let's see. Is there anything else I need to say at the beginning? Nah, let's just get to the first question, shall we?
Hey guys, I've got a question for you. My husband and I have a real quandary. We basically max out our FSA every year and then wring our hands throughout the year trying to decide whether or not we're going to be able to use the funds, since it's use it or lose it. We don't qualify for an HSA, otherwise we would do that. However, the process of submitting receipts and getting our money back is just makes me not want to do it this year, and I really would like to max out our 401k instead. So I'm wondering, would it be a good idea to put the money that we were going to put in our FSA into our 401k and then just save aside cash for any upcoming medical needs and expenses? We do have a very good medical plan, so we're not too much worried about deductibles and such. I'm just trying to figure out a way to max out my 401k, but also get a little bit of a tax benefit. And right now we're putting a lot of money into our Roth. So if I put some into the traditional, then I feel like I might be getting a little bit of a tax break then. So that's my question for you guys. Thanks so much. Have a great day.
Oh, good. I'm not the only one who hates FSAs. I stopped funding my FSA years ago because it was such a pain and it was so hard to try to predict what you're going to spend on out-of-pocket stuff a year in advance. And if you mess up, it was just... And the FSA administrator I had was such a pain about everything. They messed it up. It was too big a fight. You know, it was hard to get things accepted. I ended up giving up money at the end of the year, and I'm going, it's not worth it. It's just not enough of a tax break to make it worth it. Now, there is a tax advantage with an FSA. The money goes in pre-tax. But you're right, you got to spend it. And you can't, it's not easy to spend. They don't make it easy. They make it hard because it's, I hate to sound cynical, but that's my job. I'm the cynical guy. There's an incentive for them to make it hard for you to spend your money because they get to keep it. It's a dumb system. They shouldn't get to keep your money if you don't spend it. Dumb. Congress comes up with these stupid ideas sometimes, and this was one of them. FSA, stupid idea. Yes, there's a tax benefit. Don't give me a hard time about that. But most of us aren't that organized, and it's hard to know in advance. If you know for a fact you're going to have a $2,000 expense next year, then okay, putting money in an FSA to pay for that makes sense. But if you're trying to guesstimate, and then if the administrator's a pain, it's not worth bothering with. Plus, here's the other, but this is the meat of your question. I have a finite amount of money. Is it better to fund the FSA or the 401k? 401k! because the money will be there. You can invest it in long term and actually possibly make better money. And, well, certainly better money than you're going to make in an FSA, which could be nothing. And I think it's better for your long-term future. So if it's an either or, go with the retirement plan over the FSA. Now, HSAs are entirely different. I'm not eligible for an HSA. She was not eligible for an HSA. That's another problem. A lot of people aren't eligible for HSAs. If you're on Medicare, you're not eligible for an HSA, which I wish I'd thought about before I went on Part A. I just went on A automatically. Dumb move. We all make dumb moves. But no, if it's between the FSA and the 401, 401 wins in my book. Thanks so much for your question. Thanks for sending it in at talkingrealmoney.com or, well, speaking it in. And let's grab the next one that came in.
Hey, Don. You often recommend the Vanguard Bond Fund, BND. I wanted to get your comments on BND versus another bond fund, the BKAG, Bravo Kilo Alpha Golf. BND says it tracks the U.S. aggregate float adjusted index. BKAG tracks the aggregate total return index. So I want to hear your take on the difference there. Also interested in what you might have to say about the BKAG expense ratio of 0. Thanks.
Well, let's start with the end. 0 versus 0.03. Rounding error, basically. That's all that is. I'm not going to be a big fan of BKAG. For a number of reasons. One, BKAG is a different universe of bonds. It's the aggregate bond index, which I know this is all really weird stuff that you don't really need to think about. But basically, it's bonds that are not traded in the BKAG, which is the Bank of New York Mellon Fund. It's bonds that the Treasury holds that are included in that. It makes the portfolio kind of strange. I'm not a big fan of BKAG. One, because it's smaller, much less in the way of assets, which is going to raise their trading costs, which will offset that difference, I bet, in fees. I don't know that, but I'm pretty sure. The yields are very similar. The total returns are very similar. Vanguard's BND has approaching 18,000 different securities. BKAG has about 5,000. The credit quality of BND is higher, has a much higher percentage of AAA rated versus AA rated. I don't know why we're always out looking for new stuff, but yeah, it's not terrible. I just would rather be in BND because of the reasons I just stated. It's tradable bonds, different universe, which means you're going to end up with a few more corporates than you will governments, or a lot more corporates than you will governments. But everything in the portfolio is investment grade, so it's all good bonds in both. I'd rather have the BND because of the size and the diversification. Thanks for the question, though. And if you want to send in a question, just go to talkingrealmoney.com. That's our website. And click on that button that says Contact Us, and then record your question. You can type it, too, if you really insist. You can also call us on Saturdays at 855-935-TALK between the hours of 3 and 5 Eastern Time. Now, we have another person who spoke at talkingrealmoney.com. I'm trying to think of a better way to describe it. Another spoken thing. Here we go.
Hey, I enjoy your show. I learn lots every week. Today's episode that dropped, the topics range from annuity salespeople to homemade Halloween costumes. And I just wanted to make the statement, you missed the opportunity to discuss the scariest Halloween costumes that could be created for children. And that is annuity salespeople.
Okay. Well, and thank you so much, because we don't have Tom on the Friday show, so I appreciate you stepping in to fill his shoes in the bad joke arena. Okay, it was cute. Tom will probably use that in the future. And they are scary. Problem is doing a costume. They look like perfectly normal people until they try to sell you an indexed annuity. And then what do? I guess you could carry around a big paper that says indexed annuity and your pockets bulging with cash from your commissions. Moving along, here's the next actual question.
Hi, Tom and Don. I have about a $250,000 in CDs coming due now, and I'm considering transferring that money to VGIT and possibly BIV. These are intermediate bond funds. I want to know what you thought about those. Also considering putting some money into the iShares LifePath Target Date Fund, ITDC. How do you feel about those? Curious to get your feedback on that, and love the show. Keep up the good work. Bye.
Thanks for the comment. And going from CDs to intermediate term bond funds. The only downside is if you're laddering CDs, you will lose that semi-certainty you have of no fluctuation in value as long as you never try to sell the CDs in the interim. That's the nice thing about the CD ladders is that it feels like you're absolutely going to get your money back. Whereas with a bond fund of any kind, their value can fluctuate, and by the way, either of these have. VGIT, which is the Vanguard Intermediate Treasury, or BIV, which is the Vanguard Intermediate Bond Fund. The only difference between those two, you're going to get a slightly higher yield on BIV because it has about 40% of its portfolio in corporates. So that's a difference. And as far as the iShares Target Date Fund, it's fine. It's about a 70-30, 75-25 close fund with a 2035 date, and it's a good portfolio at a low cost. It's all indexed, and so it's just a fine fund. All of those are good choices. There's just a trade-off going from laddered CDs to intermediate-term bonds, but the inherent risk in the intermediate-term bond portfolios and the level of volatility aren't likely to be very big at all. So it's not a bad move at all. I just want you to know it's different. Thank you so much for your question. I think we can still fit in a couple more because we're moving right along. Here's our next one.
Hi, Don and Tom. This is Dan from St. Paul, Minnesota. I love your show. I have a question about fund of funds like the Avantis family has. And first question I have is, why would they have funds of funds and rather than just having people invest in the funds directly? And then second of all, would we be doubling up on fees by buying an AVGE, for example, a fund of funds, rather than buying the underlying funds themselves? Thanks for your show.
Yeah, you'd think that would be the case, but it really isn't. They don't charge extra for the fund of funds wrapper around the funds. They charge you what the fund's total aggregate cost is. So that 0.23, for example, on AVGE, that's the total of what the costs are for all of the underlying funds. And the reason you buy a fund of funds instead of buying the funds is because there are 15 funds in the portfolio. So you would have to always, every couple of times a year or every year, you have to rebalance that thing to get back to the percentage in U.S. equity, the percentage in large cap value, the percentage in international equity, the percentage in emerging markets, in large cap value, in small cap value, in real estate, in all the different categories of securities they have in there. I mean, they literally have in AVGE, the Vanguard Total Market, they have 15 equity funds, which between them probably hold 13,000 securities, roughly, ballpark. And that would be a lot of work. And you're not paying any extra for that. They're not charging you an extra fee for them doing that because basically it's just, hitting buttons on a computer program, and the computer program rebalances it every single day. So it's done for you. It's just so much easier. If there was an extra fee, we would be less likely to suggest funds of funds, but in these cases, there are no extra fees. It's just what the funds themselves cost. They add it all up and divide it by all the funds in there, and that's your 0.23%, which is pretty darn cheap, considering the more eclectic mix that you get with an AVGE, getting the small value tilt, emerging, which are much more expensive to operate. I mean, for example, here, I'll just give you an example. Let's look at the expense ratios. The Avantis U.S. Equity Fund is 0.15. However, the Avantis Emerging Markets Value is 0.36. Regular emerging markets, 0.33. There is one fund, the Emerging Markets Small Cap, is 0.42. So that 0.23 is really a pretty good deal. You're paying a little more than you are for the blue chip. You're paying a little less than you would be if you just had the Avantis. But if you owned them all, you'd still be paying the 0.23 with no wrapper fee. Thanks for yours. And if you want to send us one of yours, go to Talking. I don't even know what to call yours. I keep saying, like calls, but they're not calls. They're not always questions. They're just your voice sharing stuff at talkingrealmoney.com. I'm trying to be too literal, I think. So go to talkingrealmoney.com, click the contact form, and then record your question, comment, whatever it might be. And let's wrap things up with our final question of the day.
Hey, Don. It's Mike from Colorado. Hey, I know you don't want your show to go political, and I don't intend for you to go that route, but I would want your opinion on what this means financially. Zoran Mondani, recently elected the new mayor for New York City. He is a socialist. That's what he defines himself as. His agenda is free buses, free childcare, freeze rental rates, government-controlled grocery stores, tax the rich, tax the corporations. All this, to me, is going to lead to a disaster for the largest financial city in the world. And my opinion is you're going to have a mass exodus of corporations, wealthy individuals. A lot of the tax base probably going to move your way to Florida. Maybe DeSantis will finally get rid of the property tax. I don't know. But I just want your opinion on what does this mean for a financial future. I know you don't have a crystal ball, but this is big news. I don't think you can show me any in the world where socialism has worked. And I don't see it working in New York City. And I'm a little bit concerned on what it means for our financial future. Thanks for your response. Appreciate your show.
Look at you. You dragged me into politics, kicking and screaming. How am I going to address this? I'm going to try to address this based on decades of experience, observation, study, reading, observing, paying attention, and having half a brain. I don't know about the other half, but I got half. I have discovered, and most of us know this is true, that if someone gets elected whose politics we disagree with, we fear them. It is normal. Doesn't matter which direction. Democrats have feared Republicans. Republicans have feared Democrats. Fascists have feared socialists. It's this normal thing. This guy's going to be, or gal's going to be the worst thing that ever happened to the economy. Let's look at it practically, shall we? We've had libertarians elected to offices where it was like, well, we're going to lose all of our services. The world's going to fall apart. And it didn't. Since you asked for my opinion, here's my perspective based on my experience. And I think you would agree, if you could set aside your personal political biases, that one person cannot make that big a difference on any part of the country by his or herself. So Mayor-elect Mamdani has to work with the New York City Council, okay? He also has to work with the state. He does not have power over programs that are state paid for or sanctioned. So he can say he wants to raise all these taxes, but he can't do it by himself. There will be people pressuring him and those who oppose him to vote against some of these things. So he can try. And the other thing is that he's elected for 4 years. If in the next few years there is some sort of disastrous result from the programs and policies he's able to get through, which won't be everything he wants, I guarantee it, then New Yorkers may very well decide to kick him out. And you know that's happened many times before. We've had very liberal New York mayors in the past, and we've had some semi-conservative mayors in the past. Well, I guess if you go far enough back, they were very conservative. So the reality is one person can't do a lot. The electorate gets to have a say. There will be city council people who have a totally different opinion. There'll be very wealthy people who will be able to sway opinion because of their great wealth. There is also the attractiveness of being in New York. I have a child who lives and votes in New York, and she lives there for a number of reasons, but it isn't because it's an inexpensive place to live. That's not one of them. If it was all about money, she would be stupid to live there. Stupid. It's an expensive place to live. It might be more expensive, but it's not going to cause any disasters. We like to overreact politically. We all do it. We all do it. I've done it. Everybody does it. My wife does it. In fact, she's been following this Mamdani election, and it scared her, too. And I kept saying, don't let it scare you. It's not likely that he can do a lot, and it certainly won't affect us down here in Florida, except, as you say, we might get a few more New Yorkers moving down here. But they're doing that anyway to avoid state and local income taxes. So they're going to just, a few more will avoid them. But New York will survive in one way or another. And I lived there in 1974. Anybody who lived in New York in 1974 immediately goes, oh, you lived there in 74. It was a terrible place in 1974. It was a scary hellhole. Oh, and yet it had all kinds of great things to offer even then. So thanks for the question. I don't know that I appreciate you dragging me into politics, but I tried to kind of skate around some of my own personal biases. And by the way, I'm a Republican, folks. I'm just not that kind of Republican. Anyway, thanks so much. Appreciate it. And appreciate all of you with your questions. And I hope you'll keep sending them in at talkingrealmoney.com and even calling us on Saturdays between 3 and 5 Eastern Time at 855-935-TALK. And by the way, if you want to talk with a truly fiduciary financial advice person, we have them at Appella Wealth, and they will help you a little, up to an hour, for free, without any pressure to do anything. It's really easy. Just go to talkingrealmoney.com and click on Meet an Advisor. Or go to talkingrealmoney.com and click on the contact form and send us your questions, because we love answering them because, well, it's that thing we do. We just sit around talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor.
Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services.
Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.
Hey, Ryan Reynolds here. Wishing you a very happy half-off holiday, because right now Mint Mobile is offering you the gift of 50% off unlimited. To be clear, that's half price, not half the service. And Mint is still premium unlimited wireless for a great price. So that means a half day, yeah? Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. New customer offer for first 3 months only. Speed slow after 35 gigabytes if network's busy. Taxes and fees extra. See mintmobile.com.